Hello, welcome to the second in a series of three webinars that we're running relating to navigating labour, employment and executive compensation challenges as part of global M&A transactions. Welcome back to those of you who joined our first webinar and thanks for joining us if this is your first time. As a recap, our first webinar focused on due diligence issues and deal dynamics relating to people issues in transactions. And if you missed that, there is a recording available online, and we can share that link with you today after today's session. We got into the heart of M&A issues in that first webinar, but in today's webinar, we're going to be taking one step back and looking at transaction readiness. So whilst this is largely a sell-side focused webinar, it's helpful for buy-side parties too, so that when you pick up the transaction, you can identify those sellers who are prepared well and are more likely to contribute to a smooth deal flow. If you have any questions as we go through today's webinar, please do pop them in the chat channel. And if we get time at the end, we'll address some of those. But if not, we'll follow up directly with you. So please let me introduce the wonderful panel of speakers joining me today. We have Candace Quinn joining us from Buchanan in New York. Candace is a shareholder at Buchanan and brings a wealth of experience on executive compensation and employee benefits from the US and the international side. Candace's colleague, Christian Antkowiak, is also joining us. Christian is also a shareholder and co-chairs Buchanan's Labour, Employment, Benefits and Immigration section. And again, like Candace, has extensive experience for labour and employment experience in the US and also cross-jurisdictional with partner firms. Here in the UK, I'm joined by my colleague and partner at Mishcon, Stephen Diosi. Stephen leads the remuneration and incentives team and has experience, advising on the strategy and implementation and compliance of UK and global employee incentive arrangements. My name is Dominic Wrench. I'm a member of MDR ONE. We're one of the group businesses here at Mishcon, and we focus solely on international employment law. And I work extensively on our international M&A deals. So I've taken a nice break today from M&A deals to come and talk about M&A. So it's a large part of my life. So let's get started. So over to Candace, to you first, to talk us through some transaction readiness from a US angle.
Thank you so much, Dom, and thank you all for joining us today. So M&A transaction readiness for executive compensation and benefits matters. Now, to prepare for the upcoming transaction, sellers will really be looking to get ahead of any red flag issues and potential matters that could impact a potential price or even the interest of a buyer. The key for the seller is to look at the pension plans, executive compensation agreements, and other agreements to make sure that they do not impact the viability of the potential transaction. For future potential buyers, they were going to be looking at assessing those risks and determine if there are any red flag issues. Now, first, the seller wants to look at the type of the transaction. Are they thinking of an equity sale or an asset sale? Then they also have to take stock. Is this a publicly listed company, a multinational company? It's a part of a control group. Are there ERISA affiliates? So these are things sellers will need to determine beforehand. And then also, now let's look at specific plans and types of agreements. Now, mergers, acquisition, deal readiness is all about mitigating potential issues. So one of the first areas that sellers want to look at is the qualified retirement plans or pensions. Those pensions are governed by two statutes in the US. First is the Employee Retirement Income Security Act, also known as ERISA, and then also the Internal Revenue Code. Failure to comply with those sections of the law can result in significant costs and potential penalties for a buyer. So seller wants to get ahead of this and look at the qualified status of their plan, the funding status. Are there any compliance issues? Is there an IRS or Department of Labor audit that could impact the sale? And any related litigation, ongoing or risk of litigation? The next area in employee benefits and exec comp is to look at the incentive plans and awards. I think it's known as share schemes in the UK. Also, deferred compensation agreements and executive agreements. And in this case, the seller is looking to see, are there any terms in those plans that could be triggered upon a change of control and activate or accelerate vesting of stock options? And also they want to look at any of the agreements provide for guarantees by the company that they're going to gross up executives for taxes, or that they're going to reimburse the executives for any 409A violations. Buyer will want to know this when they do their due diligence, because those are cost issues. Another area is tax risks. So the seller's advanced planning here is going to be important to determine if there's something known in the US as golden parachutes, which is Internal Revenue Code section 280G. And they're going to want to also determine, can they mitigate any potential issues if there is this golden parachute potential issue with a shareholder vote exception. So being in advance and planning is really important. So these payments are limited to only certain types. They are transaction bonuses, severance or related agreements, incentive plans that relate to the transaction, acceleration of any equity awards, and also any increases in compensation within 12 months of the change of control. Now, the risk here is for the recipient. First, they could be subject to a 20% excise tax on the amount of that excess parachute payment and tax deduction. Now, parachute payments only apply to certain people. They're known as disqualified individuals in the US, and they only apply if the payments are made because of a change of control of the ownership or substantial amount of their assets. And they only apply to certain payments that equal or exceed 3 times a base amount, which is usually an average of compensation for that disqualified individual over 5 years. So who is in the category of disqualified individual that the seller wants to pay attention to what kind of awards they'd be getting? First, it's an officer by authority, not title, the company. It's a shareholder that has greater than 1% of the fair market value of the outstanding shares. And it's also a highly compensated employee who is one of the highest 1% by compensation of the company. Now, you can mitigate the impact of this 280G golden parachute rule if you are a private company and the company wants to take what's called as a shareholder exception. That means by a vote of 75% of the target company shareholders, excluding that disqualified individual, they have to agree to approve the excess amount of the payment. Now, this requires that all those payments have to be disclosed to all the shareholders. And secondly, the disqualified individual has to agree in advance in writing that they will forego the excess if the shareholders don't agree. So as you can see, preparing for this is really important in advance. Another tax risk is known in the US as Internal Revenue Code 409A. And unless there's a specific exception, if there's deferred compensation that does not satisfy that strict law, there can be a 20% tax to that recipient. That's in addition to their state and federal income tax. So that code section 409A is significant, and it reaches beyond vanilla deferred compensation. And it also applies to stock options, and stock options whose exercise price does not equal the fair market value of the underlying stock. So any discounts on the fair market values and exercise price will violate it. Now, this is really typical an issue for multinational transactions where US employees are granted foreign company stock or shares that are discounted for fair market value. I've seen this in a number of multinational transactions, and we have to address this with a special addendum for the US recipients. So unless a company is publicly listed, one way to get ahead of this issue is to have an independent fair market value by an appraiser before you grant the shares or stock options. Another issue under 409A, there is what's called a six-month delay to any payment that is paid to a specified employee, another category. But those payments only are for separation from service. So you can have a change of control, but if the individual is determined to be in that category and they receive what's considered to be one of these payments, then they will have a 6-month delay. Now, you have to be careful because it doesn't apply. It does apply not only to US publicly traded shares, but also to shares of a company that's granted that are on a foreign national exchange. So this is something that has to be careful, definitely in a multinational transaction as well as a US. Now, the last area for sellers to verify the compliance of their plans is health and welfare plans. Now, the status of these plans is governed by a number of laws in the US, not only the Employee Retirement Income Security Act, or ERISA, Internal Revenue Code, Affordable Care Act, better known in the US as Obamacare, and COBRA. But these notices, these requirements all have certain very strict penalties in some cases for violation. For instance, just failure to provide what's called a COBRA notice to let employees that may have been terminated that they have the right for continued health coverage is $110 a day by the Department of Labor, and the IRS can exercise a penalty. Also, penalties for failing an annual return, such as a Form 5500, which in some cases require an audit by a certified public accountant, can be from the IRS $250 a day with a maximum of $150,000 per return. And the Department of Labor can charge $2,586 a day with no maximum, all for failure to file a Form 5500. So very important to review, because there are amnesty programs that the seller can apply to that to protect any compliance issues such as this, but they're not available if the plan is under IRS audit or has received a notice. So as we've seen, the Internal Revenue Code and ERISA requirements can significantly impact an M&A transaction. So it's very important to get ahead of these issues. We recommend a mock IRS due diligence review to find and address the issues in advance. So with that, let me turn it over to Christian to tell us about labor issues and employment issues with regard to M&A transaction readiness. Thank you very much.
Thanks, Candace, and thanks to the MishCon team. I just want to start by apologizing in advance. We had a lot of great feedback after the last presentation. One point of controversy was that there weren't enough British accents on this. You're going to have to suffer through my Pittsburghese for a few minutes before I turn it over to the real stars of the show next. You know, as I think about transaction readiness, and I was preparing for this segment of the presentation, I read a survey that showed 67% of executives are finding there's more scrutiny around the deal process, and that's increased. Obviously, that additional scrutiny means things like a longer deal process, wider disparities in valuations between buyer and seller, and the need for more information. And, you know, as we think about this as folks who work in this space and do these types of deals, we think about how they can be avoided from the sell side. And in my opinion, one of the primary reasons for the trend is the failure to adequately prepare. And so at Buchanan, one of the things we do is engage our clients in an M&A readiness assessment. And so these assessments can be used to identify business issues that impede things like the speed and success of the transaction, and can impact the value achieved. So in the few minutes that I have, I want to talk about, at a high level, a number of the areas in the employment space that we go over in these types of assessments. And the first of those happens to do with talent selection and onboarding. I think people are often overlooked during the acquisition readiness process. But those pre and post transaction teams, I think, are crucial to the company's future success after the combination takes place. And obviously, developing a business succession plan can really help to protect that continuity and reduce the impact of scale after the combination occurs. Of course, you have to ensure you have key personnel in place, and that any potential retention issues throughout that process are resolved on the front end. So I think about this in terms of the who and the how. The who, of course, in terms of identifying, select, and retaining critical employees, and the how is how you accomplish that. You can use, for example, long-term incentive plans. That's something that somebody like Candace or the folks at MDR could certainly help with on the benefit side. You can also have retention bonus agreements, and there's a number of different vehicles you could use, but that's something you really need to be thinking about. The second is culture and change management strategies. You have to take stock of your culture, and certainly that can be done anecdotally, but I know a lot of clients who undertake quantitative assessments with the help of a third party to understand good fit And you need to think about that in terms of the buyer as well. For example, are there values and leadership styles, workplace environments compatible with yours? Because a mismatch can often lead to friction post-transaction, and that's going to affect employee morale and productivity. And coupled with that, I think you need an effective communication strategy that outlines how you're going to integrate those people and systems post-transaction. That's going to help facilitate the process, because a lot of employees are going to feel uncertain about their roles, the company culture, and job stability as they look to the future and what that combination means. The next area, identifying opportunities for cost cutting and redundancies. We often come across situations where one company will set out their plan on paper but not execute before the deal takes place. A buyer isn't necessarily going to give credit to those potential or future savings based on a plan that hasn't come to fruition yet. So we often advise folks to maybe execute those in advance. And of course, that could impact things like in the United States, the Worker Adjustment Retraining Notification Act, a law that requires certain notices to go out to employees involved in perhaps a mass layoff. You also need to be concerned about the impact that mass layoffs have for class action claims and discrimination for disparate impact. And so it's important to work with an advisor who understands those risks when you execute that strategy and perhaps lean up for a combination. And the final area is something similar to what Candace touched on at the very end, the legal readiness, ensuring compliance and mitigating risks. I think legal due diligence, undertaking that exercise before you get to the diligence process, it can be time consuming and a meticulous part of the transaction, but if you undertake that exercise in advance, it'll set you up for success and speed in the transaction as you move forward. And so some of the things, of course, we look at are employee misclassification risk, whether they're properly classified as employees or independent contractor, or in the United States, or wage, hour, and compensation issues. Those types of risks can be significant and impact the value of the transaction. It's better to clean it up on the front end. Pay inequity is another issue in the United States. It's a hot topic of litigation now, and ensuring that there's equitable pay across different classifications of workers. And of course, addressing union-related issues and potential organizing risk in an organization. Those are probably the top three things that I would be looking at. So that being said, those are some of the issues at a high level, and I'd love to kick it over to the folks at Mishcon for their perspective on these topics.
Thanks so much, Christian. And great to be here with everybody today, and thank you for your time in joining us. So clearly, some of what Candace and Christian have talked about will be equally important from a UK and rest of the world perspective, and at the risk of repeating, I guess, some of the messages that have been delivered, I did want to outline from a UK and rest of the world perspective the way in which we think about things at Mishcon and how we advise our clients on being deal ready, and that's sometimes both from a buyer and seller perspective. I think the key message that I wanted to get across is that nobody likes nasty surprises. It's really important to prepare checklists of data and documents and to start putting that all together early. And as we highlighted in our last seminar, that includes being able to identify reward arrangements and employees on a country-by-country basis. In global M&A, multiple advisors and teams need to work with data that also covers jurisdictional information, and well-prepared data presented in country-specific folders in the data room can keep transaction fees on budget and the deal process on time without causing delays. It's similar to what's been discussed just before, health checks. In our last webinar, we flagged some of the risks that can arise during a diligence phase. And particularly if you're on a sell side, then you should really be looking to get ahead of those issues by conducting health check reviews, not just before the deal process kicks off, but regularly as part of a business as usual compliance review. Start the due diligence work early so that any issues can be identified, remedied or mitigated ahead of the deal process kicking off with potential buyers. And from a UK incentives perspective in particular, one of the areas that we always see the most risk and where things can go wrong is with a particular type of employee share plan called an enterprise management incentive arrangement, or EMI. And that's because there's a lot of flexibility that can be delivered in that type of plan, how it's structured from a vesting, payout perspective, performance criteria. But it's a revenue tax advantage plan and subject to a lot of very strict requirements, some of which are quite easy to trip up on. And that may be around the valuation process that's conducted up front. That might be around certain declarations that certainly need to have been given over a period of time in terms of employee status. And going through that checklist at an early stage and identifying, have we missed anything? Has something gone wrong? How do we rectify it? Will be of critical importance, particularly because EMI gives capital treatment, and so you're potentially paying tax at 10% as opposed to income tax treatment at 45%, with employer social security on top. So you can imagine the disappointment and somewhat horror of a seller and the employees that if they find out at the last minute that actually they're paying significantly more tax than they were expecting, that's going to be a real problem. Moving on, I would say that, and as part of the same conversation, identify any high value and material risk areas. In particular, it probably makes sense to give most focus to the matters where there's critical mass, high value awards, or jurisdictional requirements that could cause issue. And in the context of equity incentives, that also means knowing which countries and which arrangements will trigger those employer liabilities and reporting obligations. So, for example, more and more countries around the world now require employers to withhold tax and impose social security charges on the exercise of share options. And yet on deals, we too often see employers assuming that tax and reporting is a matter for employees personally. So the company is potentially opening itself up to interest and penalties for non-compliance, which ultimately could be borne by the buyers. I think also touched on by Candace when she was speaking, consider the structure of the deal and how that will impact employee equity plans. Different deals will have different impacts, and this needs to be considered early in the process. A take private or a public M&A is very different from a trade sale with an earnout, or where you've got a sale to private equity. Heads of terms need to be looked at and agreed, and make sure that's done with a clear understanding of the financial impact of the deal. Otherwise, there's a risk of a bigger cost to a buyer than they would expect, and there may be less proceeds due to the participants. Of significant importance in that respect is understanding and either avoiding or planning, would there be any dry tax charges on the exercise of share options or other equity incentives? How do you deal with those for tax compliance purposes? It's a significant issue if it's a private equity transaction and the PE house is requiring some sort of rollover. And if there is a dry tax charge, that potentially means significantly less available cash to be able to do that. And if there is a dry tax charge, putting that onto your employees could materially demotivate, and the team going forward can be difficult to retain without some sort of solution and thinking about. And aside from purely the legal and tax analysis, just think about the general practicalities. Ask whether your payroll providers can process share-based payments and add ex-employees back onto the payroll for processing. Not all can do that, so you might need to discuss with them early on in the timetable, or even consider changing your providers. And whilst this might be a post-closing action, be aware of the country deadlines that could apply. You might only have a few days to get this done, and the Buchanan team can talk about this from a US timeline perspective. But in the UK, we often see a flurry of deals closing in March to lock in current tax rates before any increases in the subsequent tax year. And in this case, employees need to submit finalised end-of-year payroll withholding reporting to HMRC by the 19th of April. So quite a short time. So we'd often say, talk to your payroll provider early, ask them to run a dummy payroll in advance of the deal closing as a test to make sure everything can be done on time. And I think the final message of this part of the slide before I hand over is be prepared and don't be tempted to cut corners. Just as a very last example, we sometimes see equity awards cash cancelled or cash settled for the intention of taking out the administrative burden of exercising options, issuing shares, and having to buy those. Now, whilst this could work quite nicely in some jurisdictions, in others, it might actually lead to significant employer social security liabilities, and it could materially increase the tax burden on employees. And with that final thought, let me hand over to Dom, who can talk more about the UK employment aspects. Thank you.
Thanks, Stephen. I now have the unenviable task of talking after three experts on the same kind of issues, but hopefully there will be some little nuggets here from a UK or a global perspective. I think as all the others have covered on, a lot of the transaction readiness is legal minded, but it's more practical. And I think experience-based judgments on what you can be doing to get ready is just as valuable as the legal aspects sometimes. As a lot of the lawyering, doesn't actually really happen until the deal kicks off. But one area where it does happen is the first thing I'm going to talk about today, which is restructuring. And some sellers will like to think about restructuring. Often if the deal is part of a carve out of a specific business unit or a specific product that they're looking to sell, some restructuring can be helpful such that the thing that is being sold is nicely boxed up and is a nice proposition to the market. But again, within that restructuring, it's important to consider the employment aspects that might be triggered by that restructuring. Some companies leave that till the deal is signed and it's all agreed, but others like to do it up front, such that it's a nicer sell to the market. So certainly something to consider there. I think everyone has kind of covered on the health check or the mock due diligence exercise in terms of flagging risk, but I think this has another value as well, which is it's useful for the teams to see where there are gaps as well as risks. So where don't they have something that we know a buyer is going to request as part of its due diligence? Where don't we have a handbook in place where we should? Okay, can we sort that now to make our life a bit smoother down the line? And the other benefit sometimes of these kind of exercises is it allows the team to understand where they get that information and how they get it through their systems, because it's not until often the diligence exercise is going and there are a lot of requests from buyers and the internal team are kind of wondering, okay, so where do I pull that data from? Where is that document kept? That kind of thing. So there is a practical benefit as well as flagging risks to uncover. And obviously, we recommend people are obviously careful with that exercise as well, and you can do it under an innocent guise such that people don't think, okay, we're getting ready to sell here. So it's worth thinking about how those questions are posed to the kind of people where you get that information from. As part of those audit and mock due diligence type exercises, one thing that is really useful to uncover early is where there are going to be any approvals or works council processes to undergo as part of the transaction. I think flagging those to the corporate development team or the deal team upfront is super helpful, primarily so that they can build it into their timelines, because I think, as we spoke about last time, they're not going to thank us if we put a 1 month consultation period into their deal that they weren't already expecting. And this is a global thing. Whilst Europe is typically considered much more work council heavy than other countries, we've seen things like in Korea a collective bargaining agreement which required some information and consultation. So it's important that we're looking at this kind of quite holistically for the deal. I've put HR and business connection here because I think it's important for the business, the legal teams, the HR teams to understand fairly early on what role they're going to have in a transaction like this. And I'm going to speak in a second about how we do that in the correct kind of way. But too often we see quite disparate relationships between these parts of the business, and that can really slow down the deal once it gets going if people don't know who the right people are to get the thing they need or the information they need. And I think within that, I'd say think global, which sounds a bit like a strapline for a global haulage company or something. But my point is, don't just think about the ones and twos, where you have big populations. Think about where there are employees in smaller countries or this small headcount, or who was part of the deal is going to have the knowledge on the employees in India. It probably isn't the team in the US. So think about who's going to be able to get that information and have a plan in your head at least, or at least, written down in the kind of checklist that Stephen mentioned, of where that information is going to pull through at the relevant time. Linked to this point is who is under the hood of the deal, and who's aware of it, and what steps you might need to take there. A lot of companies will, get those employees under an NDA at the right kind of time in relation to the deal, to make sure that the confidentiality of the deal is protected. And look, let's not forget, a transaction can be a really long and stressful time for employees in the company, and they're balancing running a business, running a team, whilst also kind of getting this in the back of their mind and remembering not to tell everyone about it. So the incentive piece, I think, is really important, because it goes to keeping them engaged in the transaction, and also making sure there is some benefit to them to keep engaged with it as it rolls through, and we don't get deal fatigue. Global considerations, again, just remember the rest of the world. We see a lot of US deals, US-centric deals, where there are very small workforces outside the US. And sometimes they can create issues which actually end up holding the deal up, or can cause last-minute drama. So again, my recommendation is always just to be aware of those at the outset, and work through them at the same pace as we do the US diligence. And my final point from a sell side is to consider where there's any employment litigation, and where as a seller, you might want to look to close some of that out. Because litigation is somewhere where, as a buyer, sometimes they might see a blank check. We don't know which way it's going to fall, so they may ask for indemnities, or they may really push you to give a value on it that's impacting purchase price. So if there is any litigation that we think can be closed out, and the value that's attributed to that is actually better off than having to deal with it down the line as part of the process, then that's something that I think can be super helpful. So that's it, I think, from a legal transaction readiness side. We're going to move on to some kind of more general legal updates, and some kind of socio-political changes that can impact our deals from a people perspective. So back over to you, Candace, for that, please.
Right. Thank you so much. U.S. election, as many know, we had a recent election in November, and I'd like to speak about the updates with regard to employee benefits and executive compensation matters. So first, the Tax Cuts and Jobs Act, which lowered taxes and certainly provided lower tax rates for individuals that would be receiving executive compensation, is set to expire in 2025. As the Republicans in the U.S. won both the executive and legislative branches of government, it is expected that the Tax Cut and Jobs Act will be extended or even made permanent. There are even potential discussions of potential lower taxes, as the president-elect has discussed potentially lowering corporate taxes to 15%, but we will have to see. Retirement plans, health plans, what could be in store? Well, the Department of Labor and the Department of Labor's Environmental, Social, and Governance, or ESG, fiduciary investment rule will be a key focus of this new administration. It is expected that the makeup of the Department of Labor will change, and the current administration's Department of Labor ESG fiduciary investment rule, which applies to private retirement plans in the U.S. governed by the Retirement Income and Security Act, or ERISA, allows plan fiduciaries to consider environmental, social, and governance issues as one of a multiple factors when comparing two significantly similar investments. Now, this current rule has been under significant focus, and in fact, the current Department of Labor ESG rule is already under review by the Fifth Circuit Court of Appeals in Texas by a lawsuit that was brought by 27 attorney generals of Republican state in the case of Utah v. Sioux. Now, the Texas Appeals Court has remanded the case to the district court for limited review after the Supreme Court, this is the current Supreme Court in Loper Bright, overturned a prior decision that had been the law since 1984 in the Chevron case that allowed agency deference for regulations that were ambiguous. Now the court will decide what's the best meaning of a regulation. So separate from this, it is expected the new administration will rewrite this rule regarding consideration of environmental, social, and governance issues for fiduciaries that will be investing in private retirement plans. And just to know that this can be in the trillions of dollars, private retirement money. So this is certainly a very important change. But again, it's not unexpected because of the president-elect who had a prior administration, and under that administration, they had a totally different Department of Labor rule and a different executive order. For reference, under the prior Department of Labor rule held by the president-elect, under a program titled Financial Factors in Selecting Plan Investments, private retirement plan fiduciaries that invested these ERISA funds were to make investment decisions only on non-pecuniary factors, not considering ESG. Under the prior presidential executive order, which provided executive order promoting energy infrastructure and economic growth, which sought to eliminate ESG considerations for investment decisions and retirement plans, as that process may lead fiduciaries to invest in renewable energy instead of fiduciaries investing in coal, oil, and natural gas. Another area of focus will be the healthcare, or under the Affordable Care Act, or Obamacare. The new administration could look to expanding short-term insurance health plans, although they do not provide the consumer protection that is provided under the Affordable Care Act, but they have less expensive health alternatives for individuals and employees, although the length of these plans has changed under the previous administration. Now, although there was talk of repealing the Affordable Care Act during the election, and previously prior congressional votes failed, now that the Republicans in the U.S. control both the House and the Senate, they may attempt to repeal it, or they may just attack certain sections of it. We will see. So now let me turn it over to Christian to tell us what's in store for labor and employment issues in 2025. Thank you.
Thanks, Candace. Appreciate it. You know, when presidential administrations change, I think it's fairly common to see shifts in things like policy and new regulations, even interpretations of law or the application of case law to facts over time. I think it's an understatement to say we're about to see a seismic shift at this moment in U.S. politics when it comes to employment law. And in the time remaining, I want to focus on some of those seismic changes that I expect to see in 3 different agencies, because I think the impacts of those are going to affect transaction readiness. They're also going to affect employers of all types with folks in the United States. The 3 agencies, of course, at the federal level, the Equal Employment Opportunity Commission, the National Labor Relations Board, and the Department of Labor. So the first of those, the EEOC, I think the most significant changes are probably going to be somewhat delayed, at least until 2026, when the current Democratic majority rolls off and the new administration's appointments are able to take hold. Nevertheless, I think the new administration is likely to adopt a more conservative stance. I think that much is obvious based on what we saw when Trump was first in office and what Trump campaigned on with respect to things like diversity, equity, and inclusion initiatives, revising or outright reversing Biden-era policies and priorities, for example, that strengthen protections for LGBTQ+ workers, and even other groups such as pregnant workers. And that's important to understand those changes, because the changes in law, especially with respect to DE&I, could present new risks of litigation in the context of a transaction. So on the sell side, you need to keep your finger on the pulse of what's taking place there and maybe re-examine things like the scope of your DEI policy if you're preparing for a transaction. And of course, on top of that, recent Supreme Court decisions, including the Harvard UNC case and overturning affirmative action, and a whole host of other Supreme Court decisions that could potentially impact risks in a business that then set up for risks in transaction readiness. In the Department of Labor, of course, the new Trump Department of Labor will look much like the old Department of Labor, prioritizing more employer-friendly policies and rolling back regulations. There's going to be a revisiting of the independent contractor rules and I think a movement toward allowing more workers to be independent contractors. Of course, immigration reform was a key element of Trump's campaign, and I think we're going to see here fairly soon the deportation of workers, undocumented persons to countries of origin out of the U.S. And that's going to be a big issue as well and could present a risk to folks as they're thinking about transaction readiness, making sure immigration generally is buttoned up in terms of those folks who might be employed by you on visas, making sure I-9s are taken care of, doing an I-9 audit, things of that nature. And of course, the National Labor Relations Board. You know, when a presidential election results in a change from one political party to the other, it likewise brings both immediate and long-term changes to labor law in the United States. The new National Labor Board General Counsel, in my opinion, is likely going to rescind various directives by the current General Counsel under the Biden administration. And that's going to have significant impacts on things like election and related demands for recognition and the procedures that are undertaken in order to form a union and the process that goes along with that in the United States. The standard for assessing the legality of workplace rules. We've seen sort of a back and forth and ping pong on this issue over time where, you know, fairly neutral or innocuous rules on their face, such as, you know, a provision that might say employees can't be disruptive in the workplace, and whether that is sufficiently ambiguous to chill a worker in their attempt to engage in collected concerted activity, and whether or not a policy like that is valid or illegal and should be struck down. The standards used to evaluate policies like that, I think, are going to evolve. And of course, that impacts transaction readiness because you want to undertake your audit to ensure policies and practices are legally compliant and whether they need to change depending on the evolution of these standards under the new administration. We are expecting that the new board will likely back off the current board general counsel's position on non-competes and other various types of employment agreements. So as I said at the beginning, we do expect there to be a seismic shift in change in U.S. employment law. And as you think about transaction readiness, it's absolutely critical to stay abreast of those issues because it's going to be a moving target for most employers as they sort of grapple with these changes into the new administration. So with that, those are my high-level thoughts. Love to kick it over to Stephen to wrap out the UK side.
Thanks so much, Christian. Thanks again. So from a UK perspective, we have just had the first budget coming in from the new Labour government. And I think a slight difference to what Candace said is that expectations in the US, there may be tax cuts. We are seeing tax rises. And I wanted to focus on three particular elements that have come out of the UK budget, which are important on an ongoing operational basis, but again, from a transactional readiness point of view and thinking ahead, both in terms of the selling entity or the sellers themselves on how to make efficiencies through your incentives. So the first change really is to highlight the incoming increase in employer social security contributions or social national insurance contributions, as we call them in the UK. And that is that the rate that employers have to pay is rising from 13.8% to 15% from 6th of April next year. But in addition to that, the thresholds are also reducing at the same time. So more pay will be brought into this charge. And whilst it's only the employers and not the employees' national insurance that's changing, this does put employers under significant pressure to either pass this cost on to their customers and clients through higher prices or by cost cutting within the business. And actually only today, the retail industry in the UK publicly expressed its view and disappointment that this is going to lead to pay freezes, headcount reductions, and in some cases, businesses simply not being able to survive. And in a deal context, there's a few things I think that's worth thinking about and how this is going to affect it. This will put worker status compliance into sharper focus. Is a contractor really a defensible contractor from a legal perspective, or is it seen as tax avoidance to sidestep higher employer NICS costs, which applies to employees? And that's something that has been in the radar for quite a long time, and it just might come into more focus now. If the individual is an employee or director, consider whether there's going to be a UK NICS charge on their pay and reward. The answer will usually be yes, but that won't always be the case. So, for example, there might be some internationally mobile employees who work in different jurisdictions. Take advice on the impact of country by country reciprocal social security agreements to see if there is an exemption or some sort of certificate of coverage that can be obtained so that the UK company is not liable to be charged on UK earnings. And as we highlighted in the first webinar, the UK is perhaps somewhat unique in allowing employer social security to be passed on to employees. This can only generally be done in the context of share options, and it needs to be properly documented at the time awards are made. So again, check the position on this. Check it now as part of the health review. Revisit whether is there the opportunity and the ability and time to introduce some sort of statutory tax advantage share plan for UK employees, where in normal circumstances this ensures that no employer social security would be paid, and also think about whether you can redistribute or reweight the way in which your variable remuneration is paid. Can you do more equity and therefore use the ability to pass on employer social security or use tax advantage plans over cash where there is no such ability? The other big news that came out of the budget was a change to our capital gains tax rates, and this was expected for some time, but it's now confirmed that for deals completing on or after 30th of October this year, our CGT rates has increased from 10% to 18% for basic rate taxpayers and from 20 to 24% for high rate taxpayers. This is still much lower than the combined rate of income tax and NICS that would apply to your normal cash-based or non-share-based rewards, but it reduces the net proceeds employees will now be able to get. So we may start seeing some senior executives looking to renegotiate some of their compensation packages or even asking for top-up rewards to make them whole. It's particularly worth noting in the UK that we have a specific relief called business asset disposal relief, and this applies to directors and employees who generally hold shares that give at least 5% of the economic rights in the company. So typically only really available to the most senior executives or C-suites and founders. And where this relief applies, a shareholder will only actually pay 10% capital gains tax, although following the budget, for any share sales that happen after 5th of April next year, that rate rises to 14% and then 18% in 2026. To secure the 10% tax rate, we're therefore expecting some of these shareholders to be actively seeking deals and corporate reorganisations to close out before 6th of April next year. And we're already seeing additional new incentives being offered within that timeline, and with a goal and a performance criteria around getting those deals done before then. And just the final point I wanted to mention is that employees should note the incoming mandatory payrolling of benefits from the 6th of April 2026. At the moment, payrolling of benefits is voluntary, and the original proposal was for mandatory payrolling to kick in from April 2025. But to give employers more time to prepare, this is now being pushed back a year. But it's significant and it's complex, and so companies should be preparing for this soon. So you might want to bring more rigor to when employees can actually make changes to their flexible benefit choices. For example, they can only make choices and changes once a year rather than more frequently, and consider what sort of benefits are offered as well. So I think that really covers why I wanted to say from the budgetary point of view in the UK, and perhaps I can now hand over to Dom to cover some pretty important aspects on the employment side and changes that are coming into force. Over to you, Dom.
Great, thanks, Stephen. So yeah, I guess not dissimilar, sorry, to Christian as well. We're expecting some fairly large shifts in employment law in the UK. The Employment Rights Bill was published at the start of last month and is set to reform a number of measures in UK employment law. The majority of these are expected to take place from 2026, with the kind of consultations ongoing next year. So this is a fairly, a UK specific piece of law. So I'm just going to flag some changes at a high level. Essentially key topics that employers particularly need to keep in mind for future deal readiness, because these are going to be areas of change that will be the low hanging fruit for DD risk, and I think are worth putting on your radar. And I split this when looking at the changes, rather than just listing them out, actually looking at two kind of specific angles from an M&A perspective. And the first, I think, is the impact on the deal itself. And one big area I think that the changes might impact this is restructuring. There's essentially increased employee protections, I think is the kind of the headline figure from the new bill. And just looking down that risk there's going to be increased unfair dismissal rights from day one. There are some nuances to this, but currently, again, generally speaking, you don't get that until 2 years of service. So, there could be a pool of employees that, as part of restructuring, you could think you could probably get rid of quite easily and quite simply. That may now well change. Some further protections for those on with family rights, so maternity leave, those that are pregnant, and kind of the return to work periods as well. There's going to be some additional protections. There's also been some proposed changes to redundancy laws, and almost the widening of the goalposts, because there is an intention to remove the at one establishment reference to some of the redundancy laws. So again, we're expecting the scope of those redundancy laws to potentially be broader. So again, making it a more complex challenge to reduce headcount as part of restructuring. And again, increased difficulty for fire and rehire. So it's something that, again, it's not as often seen in the UK as in other countries, but it has been an option for employers in the past, and that is going to be something that may well become more difficult as well. So, generally speaking, the environment is going to become more employee friendly in the UK, and frankly, just making it a stricter employment landscape for employers generally. So that's the kind of the deal side of things. And then, fundamentally, as a result, with stricter, more employee friendly regulatory environment, there's going to be more due diligence issues to uncover. And whilst, on the face of it, I don't think any of these, at a starting level are going to be huge risk in terms of financial liability. They're basically going to be another opportunity for employers to get their house in order. These are things that diligence exercises are going to be picking off. So, has the employer complied with the new duty with sexual harassment, and the proactive steps that an employer has to take now in relation to that? Have they complied with the statutory sick pay that employers are going to be available again as a new day one right? The same with kind of parental leaves and right to flexible working. All of these kind of fundamental aspects of UK law are set to change and become more employee friendly. So from a sell side point of view, it's going to be much like Christian said from a US perspective. Firstly, working out what your new duty is, and then secondly, making sure you're actually complying with it. So it's basically just going to, I think, increase the complexity and timeline for those transactions which have a specific UK aspect and a large headcount here in the UK. But that's all I'm going to talk about, because there's still some opportunity for change in that in the next year. But I think it's good for those kind of issues to be on your radar, and we can pick those up again as we go into the future. And this is a bit of a shameless plug, so I apologize in advance, but something that we do on the MDR ONE side is we have an update channel for key global employment law updates that kind of come out, anything employment related, and we have a mailing list for that. So if you do want to be part of that and get those updates globally, into your inbox, then please just reach out afterwards and be sure to get you in the loop on that. So I think that's it in terms of core content. If you could just flick onto the next slide, please, B. The CLE keyword for those that this is applicable to is readiness. And I'll let you just read those instructions on screen. But we'll share it with you after as well in case you don't catch it. But yeah, for those, this is a part for you. Readiness is the keyword from a CLE perspective. And I'm going to head over to Candace this time for closing comments. But thanks everyone again for joining from my side.
Thank you so much. Thank you so much, Dom. And for all of you to know post-closing integration and harmonization. Now, this is not the discussion for today, but we do have a webinar in 2025, which will address this. Now, if you are on the buy side, this is a crucial post-transaction phase and to remedy risk issues that you identified in due diligence. And it's from deal's perspective with post-deal new incentives to be addressed and post-closing risks, terms and conditions, and benefit allegations. This will be an opportunity for all of us to discuss some of the issues from the buy side, as well as the sell side, that need to be addressed with regard to post-closing. So from everyone here, I want to thank you very much for joining us today, and I hope to see you in 2025 for our next webinar.